All right, so let's begin. US President Donald Trump made a major announcement imposing new tariffs of up to 27% on India along with the other 180 countries. Now, this move has sent shockwaves through global markets, raising concerns about its impact on trade, businesses and economic growth. Now, Trump's reciprocal tariff policy could pose short-term risk for Indian investors, especially those holding IT, pharma and auto stocks. Now, however, with a well-diversified strategy and focus on India's growing domestic economy, investors can navigate the uncertainty and find new opportunities as well. So in today's discussion, we break down Trump's latest tariff decision, its immediate and long-term effects on India, and how businesses and policy makers should prepare for the road ahead, and India roles in the new world trade order. So you guys need to stay with us as we analyze this developing story with experts and industry leaders. I have with me Feroze Azeez, Deputy CEO Anand, Rathi, Sunil Subramaniam, market expert. Good evening and welcome to the show. Feroze, along with India, just like India, all of the nations would want to negotiate and would want to come on common grounds with the US, right? So now in this particular scenario, could we see more protectionist policies coming up from US, making trade even tougher because there are so many other countries wanting to negotiate, okay, and maybe over there Trump too can offer, a cut in the tariff rates also. Also, what scenario would you like to paint and, help us understand tariff impact on India's GDP and growth and trade deficit in the coming quarters, Feroze?
Yes, Kavita. See, of course, like Sunil sir explained, the logic of why both these countries need to come to a mid-ground. There's a compelling reason why India and US have to work together. I personally think this whole unsettlement of global trade is going to be immensely beneficial to India, like again Sunil Saab said. Why do I believe that is? Like US has a $320 billion export or a trade surplus with the US, not even just the export. You look at other countries, if you see Vietnam is $120 billion surplus, and then you have smaller countries also having very large surpluses. When you look at India, it's just a $50 billion surplus. Of course, 87% of all the goods we export are impacted by these tariffs. So it's practically everything is getting impacted. So it's going to have a short-term impact. But I personally think that if you look at India's positioning over a long period of time, because India is going to be the chief source of manufacturing for the US, and I concur that it could be the second India, second China. India could be the China for the US over the next 10, 15, 20 years.
So now, Feroze, in this context, how about international investment scenario? How has that changed? China was just picking up, after a very lull period for almost 3 years, if we can say. Valuations were really reasonable, even it was attractive for FIIs. Now, again, there is a twist in the story. We talk about investing in emerging markets, even from a FII's point of view, from your HNI clients and from a retail investor point of view also. Which international market really looks stable, if at all one wants to diversify? Or it's the time to just, stay away till the time we have all of these trade policy issues sorted?
See, there's the two kinds. One is an Indian investor investing abroad. The other is FII's interest in India because of its relative better positioning during this situation. Can that increase? Then coming to a mutual fund investor who wants to invest globally, should he use funds? Should he use a specific market? So to my mind, I think the US market is something which has done significantly better than India, but the US GDP or the economy has not done as well as India has. The earnings growth of S&P 500 over the last 11 years, where it has outperformed Nifty, even in dollar terms and rupee terms, is somewhere where I think that the US market is a little stretched. It is stretched because it has become valuation agnostic. It has become valuation agnostic because 80% of the investments are index funds. Index fund investing is got nothing to do with valuation. It buys momentum, right? If the top stock does very well, its weight goes up. If its weight goes up, more money comes in. More money comes in means more price has gone up. More price gone up means more weightage. And this vicious cycle is what has taken US significantly ahead than the global market. India is a valuation sensitive market. If you look at not more than 10% of the money is index based domestic. So point I'm trying to make is don't run towards US from an investment standpoint. I think that bus is missed. Point one. Point two, you can invest in other markets. Of course, but not at premiums like they have been. I personally think using the LRS route for an HNI is more sensible because you're going to be more cherry picking than just using the mutual fund route. Then coming to FIIs, money into India, I am reasonably bullish. The kind of exits which we have seen, almost 3.8 lakh crores, which has gone out, I think it's the fag end of the exit. Of course, the foreign investors were considering India to be a very, very overvalued market. But if you look at the small cap 250's earnings growth, that has not been bad. That's been 13% expectation for this year. And the first 9 months have panned out reasonably well. Of course, 1 or 2 quarters have been bad. And if you remove outliers, especially those which have a 900 PE, those are technology businesses. If you remove them, at the mean and the median PEs are not so bad, even in the small cap space after the latest correction of this calendar year. So valuation seems now in the zone of almost intriguing FIIs back again to consider investing. So I'm reasonably positive the next 1 year, 2 years, FIIs come back in. And FIIs are so price insensitive. If they decide to buy something, they buy it irrespective of price. We did a study. Every unit of money invested by FII results in a larger price movement because they're a price inelastic group. Unlike a domestic fund manager, he is very specific. If he wants to buy this business, he's so price sensitive. I've had interactions with fund managers. They say they're positive on this stock at 100 rupees. At 120, they don't want to buy. So I'm reasonably positive that if FIIs come back in, it will be difficult to catch the market. And getting back to peaks isn't going to be so difficult if FIIs turn positive, which seems likely.
All right, so interesting takeaways from this discussion. First being India, the new China for the US, and for all the investors, as explained by Sunil sir and Feroze, it's time for Ghar Wapasi. Thank you so much for being on the show today, both of you, and helping our viewers navigate to these times. Thank you.